Okay, a while ago somebody wrote and asked me if I could explain the simplest explanation video regarding a regular stock. I think that was how he posed the question. So it's taken me a little while, but I finally put something together, and hopefully this will explain it a little bit better. So this is a similar diagram to what I did in the first video. And just to quickly go over it, if this is the market price in here, say that's $25, and the call strike price is say 28, and the put price is say 22, whatever. When you purchase an option, you get what's called the break-even price, which is slightly higher than your strike price or slightly lower than your put price, because you have to still pay your commissions. Okay, so then once you purchase the option, the stock price has to go beyond the break-even point in order for you to be profitable. So it has to sell up here, or it has to, drop in price down into this profit area. Anything in here where it ends at a price anywhere in here, you lose. The house wins. They keep the money for the option, you get nothing. And by buying the stock and not the option, anything above your market price is a profit all the time, 100%. Except of course for your commissions. Now, having watched a bazillion videos on not only options but trading, I kept getting shut out of trades because it would drop below 2% or whatever the formula was. And so after about 6 months, I decided to have my own personal risk fund between like $500 and $800, so that I could stay in the trades, because I've only been trading for about 1 year, and as most of you know, this past year has been a complete nightmare for the stock market. A nightmare in the sense that it's up one day, down the next. You can't really call it a bear market. You can't call it a bull market. It's just been crazy. It's been all over the place. It's been one debacle, and now it's the economic fall. So it's up one day, down the next. So because it's so volatile, I can remain in the trades because I have my own personal risk fund, which seems to be working much better for me. So in terms of explaining the options in terms of a real trade, I have this diagram here. So this is the 200-day average. This appears on most of the charts if you have your chart settings set up to track the 200-day average. Okay, and the stock price always goes above it and below it, above it, below it. That's how stocks move. They never just move in a straight line. They always go up and down, and they're always seeking back towards this 200-day average, because the 200-day average is of course averaging the last 200 days. So it drops below, then it goes back, and as another person who did a video was explaining, that the stock is always going to return to that 200 mark because that's the average. So if it goes up, eventually it's going to come back down, even if it's up for a while. So that being the case, if you're looking at the chart and you're now envisioning that same option chart that we were just looking at, this area, it has to go way up in order to be in the profit area, or way below to be in the profit area, unless you purchase something that's in the money, but those are usually very, very expensive. So this is the reason why I don't use the options, because I'll give you an example here. Let's say this is a company that you really like, you've been following it for a while, and maybe it had a bad quarter or whatever, but it came down, and now all of a sudden you see that it's going back up. Okay, so if you purchase it here, it's below the 200-day average, and it goes up. All of this here is profit. That might be like $3. So if you have 100 shares, it's, $300. Okay, then, maybe you take a profit here. Then if it goes back down here, you buy it again. Okay, when it starts going up. From here to here is all profit, and that would be, a win. It would be, a profit for you. But if your strike price wasn't here exactly, then you get nothing for all of this movement up and down. So for the smaller investor, I really don't see the point in doing the options, with one exception. Anyway, the one exception would be, like, say you weren't in Walmart, but you noticed that Walmart, had a bad run, and the price of the stock dropped quite a bit. And you said to yourself, that's a great company. I know it's going to come back. If you wanted to, like, purchase an option for a year later that it was going to go up, say, a couple of dollars, then that would be the one exception, because you would be, buying against your opinion that it's a good company, it's going to come back, and you wouldn't have any risk. And you'd have a whole year that you could trade the option if it did come back and go up and, go into your profit area. So that would be the only reason that I would use it. Now, I'm not suggesting that these big fund companies who have, software running day in and day out, haven't figured out some fiendish way to make this, all of these options work for them. I'm sure that they have, and it's probably at all of our expense. But for the, single investor, especially for a new investor, to me, it just seems like the house always wins. If I could put it in, that kind of a phrase. So anyway, I hope this video explains a little bit more the first video about the simple explanation. So thanks for viewing.